So I'm Jeremy, not Mitch. For those of you who don't know who I am the in-house insurance agent for Goodwin. I am not a Goodwin employee. So for those of you who might get that confused, I'm actually a separate company. My company is called Community Policyholders. We are an insurance agency. We are a broker. So we do go out and get bids for communities, but we also help with Goodwin accounts to service their insurance needs when we can. Okay, so this may be that we review policies for communities that we don't insure. We may answer questions about deductibles, give them pointers on what they should do for budgeting season, etc. Just giving them our input on the market trends, what's going on, what's happening, what's changing. We are specifically only for associations insurance. So what that means is I don't do your personal insurance. I cannot write your homeowners, car insurance, anything of that nature. I am licensed to do so. I just don't have the carriers to do so. Okay. I will say that I am able to write anything from condos to single family homes to master policies that are big, master plan communities to commercial projects, industrial parks, etc. Okay, so we can do pretty much anything that is an association type community. I cannot or will not do things like a business, like a restaurant, or a business specifically, something of that nature. Okay, now I did say this earlier for those of you who weren't on already. I will be have the chat up available to see. So if you do have a question and you want to pop it in the chat, you can do that. If you do have a question along the way and you feel like you have to ask it right then and there, please feel free to do so. But for the most part, if you can, try to save those until the end. There will be a time for you to ask questions for us to circle back. I may answer your question along the way. So if you have a question, write it down, see if I answer it. If I don't, let's circle back to it and touch on it because I'm sure it's going to be pertinent to a lot of people. I will first and foremost start briefly about what happened recently with the freeze that occurred in Texas. So we've gotten a lot of questions lately about if the removal of trees or downed landscaping or things of that nature, especially in the Austin area, would be covered by insurance. And my short answer is, I don't know. And you would think I would know, but the issue is each carrier is going to look at that differently. We found out during the freeze in 2021 that some things are going to be covered. Sometimes that may be the removal of the trees, that may be some of the plants, etc. And with most carriers, those things are going to be excluded. Freeze is going to be a non-covered peril, and so they may not have coverage. We have also seen carriers make exceptions during these large events to cover certain aspects, such as removal of trees or debris cleanup, as a goodwill gesture as part of their claim, because they're very small claim amounts when they do have those. So the best thing to do is to speak with your agent first, see if that cleanup or those damages are going to reach a deductible that you may have, see if you have coverage for things like landscaping, and then move forward with doing a claim. And the reason I would say move forward with doing a claim, one, if you don't have coverage or they deny coverage, then you're not going to be dinged like you would with other events that occur, such as like a fire, a busted pipe, something of that nature that may not be covered. But you will still have the possibility of getting that coverage. Condos are going to be a little bit different in the sense that their property policies don't necessarily speak as well to outdoor property as they do to the building property. So it may be one of those instances where they don't even have language written in there that is specifically to some events like this for outdoor common landscaping. Okay, so again, there may be exceptions made. There may be some coverage that you may not think you have, or coverage that your agent may not think you have, that is actually available. Okay, so again, speak with them, see if it's going to be valuable for you guys to make that claim, and then go ahead and make that claim if you and your agent think it's a good idea. I will say I will review policies to see if they have a coverages, but I am not the carriers, so I cannot determine coverage. I can only interpret the policies in which we are written with the carriers input that we've had from the past. Okay, so only the carriers can truly determine coverage or non-coverage. Okay, so it is not, I'm not saying just submit it and pray. I'm saying talk through it, see if it's worth it, and then submit it, because you may be one of those that are lucky enough to get that coverage. Okay, so that being said, any questions quickly about the recent freeze claims that have gone on? So Dean, does Goodwin as your property manager contact insurance companies on your behalf? Yes. Okay. Now it is the board's direction for you guys to determine which agents you guys want to go with. So I will say, a lot of times they'll come to me, they'll come to other brokers that they've worked with in the past. They may go to a specific carrier like Farmers. Farmers agents don't have brokers because they are a single insurance company. Same with State Farm. They do write commercial insurance. We'll talk a little bit about that later. So yes, they will approach those on your behalf. If you are with an agent who's like me, we go ahead and shop you to as many carriers as we can at renewal if we have control of your account. If we are trying to quote you on new business, then we will take you to everywhere we have available to us. I'll explain that in a second with the blocking of markets and what that looks like. Okay, so as we get doing this, I'm going to share my screen real quick here, and we're going to go straight into the presentation. Okay. So first and foremost, with mine, we do have, and I did not put all these transition in, so I apologize. Oops. Okay. These are going to be our contacts for my agency alone. So we do have a specific certificates desk, and we do have an info email. So if you cannot reach one of the 3 people listed below, we did just hire a 4th person. I'm not going to put them on yet because they are still within training. But these are going to be the contact information. This will be made available to you. Your property manager should also know all of these emails, but these are going to be the ways that you're going to be able to contact us. If you need a certificate, we do have a specific desk that is just for certificates. And then myself, I'm the agent, and then I have Rebecca, who is my senior account manager, and then I have Brittany, who's an account manager, all of whom are very knowledgeable, can speak to insurance. When it comes to coverage explanations, I'll be doing that. Most of the time, they are there to help with obtaining quotes. Okay. So just a little bit about us. I did briefly talk about this. So we do only community associations insurance. Because of this, we do know the market very well. We do get information direct from carriers pertaining to this niche market. Okay. I cannot speak to rates and such in the personal areas. I can speak more to your commercial side of things. This is a commercial policy, so it is written in languages that are going to be able to go across multiple industries. So you may see terms like employee or building or townhouse that are used by carriers that may not pertain to you, but really for them, it's the language in which they use, because they use a very general language for these commercial policies. Okay. We do have a service team. I do also have a claims manager who specifically does our claims for us. We do have our own in-house financing and accounting department. So we do have the full service aspect for you guys. These are the types of policies, and I'll touch briefly on each one of these when we get going, that we do on a day-to-day basis. Okay. So for the most part, you're going to have your commercial property, general liability, directors and officers, crime, fidelity, umbrella, and workers' comp. Those are your main policies. Flood, boiler equipment, employment practices, earthquake, and any other things like a volunteer policy, these or special events policies, these are going to be things that are going to be ancillary that may only pertain to your community specifically. Okay. So you just got to look at what your needs. For those of you who didn't know, the freeze in 21 actually just kind of shifted this in market greatly. Okay. The big issue is that it was the largest insurance claim in the state of Texas history that surpassed any tornadoes, any hurricanes, anything. It is the largest singular event that ever occurred. It put 2 companies that I know of out of business. Okay. When you put a company out of business, not only did you lose a company that could write competitive rates, but you also lost all these communities and then had to go to other places. The other thing it did is it shifted the guidelines of most carriers to be specific on things like the age of buildings. Okay. And the reason it shifted was they saw most big claims occurred in places that were not up to standard codes of today. What happens is some of these communities, especially condos, were grandfathered into codes that may not be, as well done today as they were in the 1970s or 80s. For example, you may not have proper insulation on, your sprinkler pipes. You may not have proper insulation on your pipes. Texas was not built for freezing to occur for that long and that, in this way. And so they saw that places that were built post 1995 typically didn't have as bad of damage as anything pre 1995. So a lot of big carriers changed their guidelines to say, we won't write anybody that is built prior to 1995. Some have even moved up to being prior to 2000. Okay. So that caused a shift in where a lot of communities, especially older communities, had to find insurance. So when they had to shift where they found insurance, it overloaded what used to be the last resort companies are now becoming the first choice companies. And this caused rates to increase. And I'll explain why here in a second. Okay. Other things that have happened is prices of, inflation in general has hit our economy and has hit this industry just the same. The cost to rebuild a building now costs more. So when these costs have gone up, the premium goes up. Okay. Because if you're going to insure more coverage, you're going to have more coverage, you're going to have more premium. All right. Now, going back to the shift, there are 2 types of carriers in insurance. You have admitted carriers in the state of Texas, which are backed by the state of Texas, and you have surplus lines. Surplus lines are things like Lloyd's of London. I'm trying to think of some other ones, RSUI, some of these carriers that used to be the last resort. You had bad claims, or you had an open claim, or you had aluminum wiring. These were the companies that would write you. Now, with the guidelines shifted from these admitted state-backed markets, you now have to go to these surplus lines as your first resort. Well, they were always expensive to begin with. Now they're more expensive. The reason is they have quotas to hit, but they also have a cap on how much they can actually write in a year. So what they look at is, in the past, pre-2021, they would maybe get $500,000 worth of premium across their desk as an underwriter at a time. Post 2021, they may be getting $3, $4, $5 million worth of premium across their desks at a time. So they would say, hey, you need insurance. I'm going to write it at this amount. If you're not going to do it, and I'm not going to budge on my numbers, then the next 10 people in line are going to write that. But we only have so much cap space to actually write these figures. Okay. That was the big reason for large jumps in 2021 and in 2022. For 2023, we are starting to see the influx of new carriers into the market. Because of these new carriers, some prices are starting to level off or starting to go down. Okay. I've seen some drop. I've seen some go down in premium. I've seen some that have started to take the load off of those that would no longer write pre-1985. Okay. So because of these companies, the overall premiums are going to level off at least, and they're not going to jump, 150% like they were. They may go up only 5, 6, 7% if they're going to go up at all. Okay. So it is important that you work with a broker, because a broker would be able to take you to multiple carriers and get you multiple quotes, or at least find the best options for you price wise and coverage wise, because price is not always the determining factor on good insurance. And make sure you guys are actually getting the correct coverage. Okay. Do you have a question from Ryan? Do you have any figures on inflation related to condo properties? So in general, with inflation, what we're seeing is, and I'll talk about this in property when we get to it next, but I'll touch on it real quick here. The inflation we're seeing is cost of construction labor, cost of materials, cost of reconstruction. And because of that, building values have gone up. So what used to be a price per square foot in insurance for us has gone up 10, 20, 15, $30. So if you have a 10,000 square foot, facility, and you've gone up $10 a square foot, you just added $100,000, okay, in value. So you start to see these increases, and you get into the bigger properties, you're going to have these larger increases. Also, some places were underinsured. People used to underinsure all the time, and now that they're seeing that they're going to cost more to rebuild, they don't want to underinsure you. So the inflation part it's really not as big in the sense of actual numbers. We're looking at the price per square foot. We're seeing the increase of the price per square foot. So for North Texas, 3 years ago, it was about $100 for bare walls coverage or walls out coverage per square foot. Now we're seeing it at about $125 a square foot. Original design or a walls in coverage used to be somewhere around $125 to $130. Now we're seeing it from $150 to $185 in North Texas. Depending on where you're located in the city, zip code, counties, etc., that's going to affect the price per square foot because of the availability of materials, availability of workers, etc. But that's kind of the general ballparks that we're seeing, at least in North Texas. I can tell you in Austin, it's similar. Unless you get down into the downtown area, it's going to be a little bit higher. Okay. All right. One other thing I wanted to touch to you guys about, and this is a recent thing that I've been seeing with other communities that have different insurance agents. So interest rates on your finance agreements are going up. The last 2 finance agreements that I've seen with other carriers have been 10 and 9%. Okay. Now you don't think that that's that big of a deal if you have a small premium, but some of these condos are doing something of like $110,000, $130,000, $150,000 premiums, and that 10%, you're adding an extra 15 grand onto this. The good thing about us is we do in-house financing, so we do have control over our financing rates. We do agency bill, so if you miss a payment or are late with a payment, there are no late fees, and there is no cancellation straight off because the carriers are paid by us, and you're essentially paying us back. That is an advantage of working with us. But our interest rates are lower to begin with, okay? Starting at 6%, most of the time our common one is 4.75%. And if we have dire straits and we need to win your account and we want to help you guys out, I have control over it to where if I need to drop it down to 2%, 5%, whatever, I can. Okay. So just so you guys know, we do have those availabilities to help you guys out if need be. Okay. Hold on here. Sorry about this. Trying to let people into the waiting room. There we go. Okay. All right. So, all right. Next section. Okay, property, general liability, crime, workers' comp, D&O, and umbrella. Like I said before, these are going to be your most, how do I say this? Your most common property, policies, okay? So when you have these, you're going to see on your certificate of insurance, some of you may only have property, some of you may have general liability, some of you may just have general liability and directors and officers. If you are managed with Goodwin, you will need to have at least, okay, and I say at least, the general liability and directors and officers. Okay. So I will touch base on these. This is a general sense. I do put the umbrella over here because the umbrella does only go over the general liability and the directors and officers. It does not go over property crime or workers' comp. These are set limits, and so they are not the same. So they are not available for it. Okay, property. Okay, so we look at communities two ways. So you'll hear these terms: single family home. These are typically your detached single family residencies. Sometimes they could be townhouses that are connected, but each individual unit owner is responsible to insure their entire unit. Then we look at condos. Condos can be townhomes that are side by side or stacked. Okay, condos, we refer to them refer to them as condos as long as we are insuring the residential buildings in some form or capacity. Single family, no residential building coverage. Condos, residential building coverage. That's not to discount the outdoor common area property or clubhouses or things of that nature. But when we talk about a property, we talk about them as either a single family or a condo. Again, townhouses or row homes, a lot of people call them either. Those can go either way. It depends on the governing documents. Now, we do hear the term master policy a lot, and it's actually a misnomer. Okay, so the association's insurance could be what can be referred to as a master policy, but we have what we call master communities that actually have sub-associations, and that is what we call a true master policy, okay, because it goes over multiple associations. So you have the association's insurance or association's policy. It's not really a master policy. Okay, a master would be a community with multiple sub-associations. Just talking briefly about some things here. So total insurable value, you may see this. You may also see the term SOV or statement of values. These are things that need to be reviewed for you guys every 2 years. How much are you insuring your property for? Okay, this could be your fencing, your gates, your benches in your community, playgrounds, pools, clubhouses, and then of course your residential buildings if you're a condominium. Okay, again, it's whatever the association is responsible for replacing that you feel needs to be insured. Monument signs, walls, okay, retaining walls, things that can be hit by a car, mailboxes. The United States Postal Service used to insure mailboxes for everybody. They no longer do so, okay? They may add some coverage to it, but for the most part, you should add it. So if somebody vandalizes a bunch of mailboxes, you can go ahead and have that replaced, okay? So talk to your agent to see what all the property that you have insured on your policy is. It should be listed out by items or by groups of items. For example, if you have a pool, a tennis court, and a perimeter wall, that all could be grouped together. The fencing of all of those things could be grouped together under one value, okay? But you still need a value for fencing, okay? So that is something you want to look at your total insurable value, and that is going to be what your limit is, or your premium is based off of, is how much value you have. Okay, Cliff, I talked about the ice storm earlier. I'll touch again on it at the end here when we talk about claims process, and then we can go back to it, okay? Types of valuations. So guaranteed replacement cost. This is the best policy on the market. We do have a carrier that will write this. It is CAU. Essentially, it's a no limit policy, okay? And what I mean by no limit is they have a rateable limit that they base your premium off of, but if you had a total loss, you're not going to have limits on how much your reconstruction is going to be. The great thing about that policy is it takes the guesswork out of your hands on if you're insured, underinsured, or overinsured. Okay. Insured to value, or what we call 100% replacement cost. This is 90% of what you're going to see out on the market. So if you are insured for $1 million, you get $1 million if you have a total loss, not a penny more. Okay. But you'll get $1 million. So if it costs 1.2 million to replace, that 200,000 extra is on you guys. Okay. Actual cash value. There are some of these policies out there. I will tell you, if you ever see an actual cash value policy that is not, and I'm not talking about for roofs, but in general, avoid it at all costs. Okay. You'll see this mostly when it comes to roofing. On the roofs, they may take into depreciation value and look at the actual cash value there, because they may be able to give you money back. If your roof was replaced in 2018 and you have a hailstorm now and you have to replace it again in 2022, a 30-year shingle, and you're replacing it after 4 years, there is some value to it. They'll give you some money back towards it. Okay. 80 to 90% co-insurance. This is one that is common. It's not necessarily a bad thing if your values are up to date. Okay. Now, most people are going to say that this is like home health insurance, right? You're only insuring us for 80%. We have to pay the deductible, and you give us 80%. We have to pay the other 20%. It's not as simple as that. What they're really saying is you're valuing your property at 80% of what we actually think you're valuing the property at. So we're going to insure it for 80%, which is going to be a lower premium because you're not insuring it for the full value. But if you had a total loss, then you will be on the hook for the other 20%. So there is that threat at that point. But what they're really saying is that it's very unlikely you're not going to have a total loss where you're going to lose all 100% of your property value all at one time. There will be things that can be salvaged, and you got 20% that you can recoup in that sense. So there is some value to that. Now, if you do not value your property correctly, or your agent or your insurance appraisal or reserve study or whoever doesn't help you with this, then there is a possibility of a penalty. Okay. And the easy formula to some is what you did insure it for, how much you should have insured it for, times your loss. Okay. So if you were supposed to insure it for $1,000 and you didn't, and you only insured it for $8,000 or $800, then you've got a $200 difference, or a 20% difference. Okay. And then you would multiply that by the loss, and you would only get 80% of what your loss is. And then you've got minus your deductible. It's rare that this comes into play. I have seen it in a couple of places. Condominiums should not have a co-insurance clause on there for 80 or 90%. First off, Fannie Mae and Freddie Mac will not like this. Secondly, it is a very risky thing that if you had a full building burn down, you could have some penalties that come onto it at large amounts. Single family homes, where you're only doing the outdoor property, this is a much safer thing, because even if you had a loss and you had a penalty paid on it, it is going to be much smaller and maybe easier to manage at that time. Okay. Some quick things. You might see on your certificate of insurance, all other perils or AOP deductibles. This is for anything that is not specifically specified as a deductible. You might have on your certificate of insurance a water deductible, or most commonly a wind and hail deductible. AOP is all the other things. So fire, lightning, water damage if it's not specified, equipment breakdown, vandalism, theft, etc. Okay. Typically, 1,000 is for single family homes. 2,500 is the start for HOA or for condominiums. Okay. Wind and hail buy downs, or wind and hail deductibles, excuse me. Okay, this is the most one of the most common questions that I get when it comes to insurance. Or one of the biggest questions of should we go with this insurance or not is the wind and hail deductibles. Most deductibles now are going to be percentage. Very rarely are you going to get a flat rate anymore. Typically, the lowest is going to be 1%. I've seen as high up to 7%. Okay. Now, when it comes to these deductibles, you're looking at how much you have per item in which you're doing. So, for example, if you're a single family home and you have a 1% wind and hail deductible and you have a fencing claim for your perimeter wall, then they're going to look at the value of that perimeter wall, and it's 1% of that value. So if it's 100,000, your 1% is going to be $1,000. Okay. So it could be advantageous for some of the smaller communities. For the bigger condos, when you get into millions of dollars worth of value, this can be very, very big deductibles. They shifted to this about 5 years ago when a lot of places were having massive hail claims, and the associations were only having to pay a $2,500 or a $5,000 or a $10,000 deductible for $1 million claim. Insurance carriers were realizing that they were losing their tail on it, so they switched it to percentage, because then it's based on the size of the community. So the bigger the community, the more deductible that they're going to pay, because the more likely it's going to be a larger payout. For example, I have one today that I was working on that is a $38 million, 35 building condo community. Okay. Their wind and hail deductible at 38 million. If it's at 1%, you're talking $380,000. Okay. So what can they do? They don't have $380,000 in their reserves to buy this down or to pay that deductible. Well, they can do what we call a wind and hail buy down or a wind and hail buy back. Essentially what this does is it takes whatever wind and hail deductible you have and lowers it to whatever you want it to be. You could go to a flat 25,000, you could go to a flat 50,000, flat 100,000, or you can go from 2% to 1%. Okay, it doesn't really matter. We can get to whatever area you want to be. You're going to pay for it though, because whenever you have a wind and hail claim, this automatically kicks in to pay half of what or whatever deductible portion they're covering automatically, because your main property policy does not change. This is just paying something on behalf of your community. So if you have one claim in a year, this would be helpful. If you have 2 wind and hail claims in a year, this is really helpful, and so on and so forth. But if you don't have any wind and hail claims, you may be paying extra premium to something that may not occur. Okay. So it's a roll of the dice with wind and hail. We live in Texas. We have tornadoes. We have wind and hail all the time. That's why we have these deductibles. But it's one of those things that if you want to do it, we have that available for you. Okay. And all agents should do it. All wind and hail buy downs are written by Lloyd's of London. So there is no real difference between one agent or another getting you a wind and hail buy down. It's pretty much a set rate. Hurricane deductibles, if you live close to the coast, you might have a named wind and hail storm. This could be the same as a wind and hail, but it says specifically for named wind storms. Flood and earthquake, most policies do not have flood and earthquake on them. Flood is FEMA controlled, so please make sure you talk to whoever you know about if you're in a floodplain or not. You can now get flood coverage if you are not in a floodplain or do not have elevation certificates. They did up the cost of flood coverage, but it is still manageable if you want to add flood on a certain building or in a certain area. I will tell you, flood is one of the most tricky policies for agents to write because it is government backed and it is not, there aren't many carriers that write it. Earthquake doesn't really apply that much in Texas. There are some carriers that will add some coverage onto their policies. Some may not. We can get a policy for you if you want to. This would also cover things like sinkholes. I know that had been a problem in Austin and a few years ago, but it is something that we can get if needed. General liability, I will touch quickly on. This is going to be your slip and fall or general policy. I always call this your catch-all policy. This is going to be your main policy if somebody sues the association for an injury, a death, a drowning, something that occurred within the association that is not directly related to the board or a decision made by the board. So this could be somebody got drunk at an association event and got into a car accident and they sue both that person and the association. This policy would kick in there. Okay. Excuse me. Most of you will have limits that are 1 million per occurrence or 1 million per claim and 2 million for the aggregate or 2 million for the entire year. So that breaks down to being, you could have $2 million claims, 4 $500,000 claims, 8 $250,000 claims, or any combination thereof around there. The most they'll pay out in a year, a policy year is 2 million, but only 1 million per claim. Liquor. If you have a clubhouse and you want to serve liquor, I would make it a BYOB type situation. Okay. Now they do understand that you're going to have parties at these clubhouses or community centers. Excuse me. So the things to avoid: selling, distributing, creating and really even serving alcohol. This should be done by licensed professionals, vendors that you bring into your association. Again, it should go without notice that, alcohol around a pool is always a no-no. Not saying it won't be covered, but it's just one of those things that you should have that rule anyway, because it limits your liability as an association. Now, you could do things like have a wine food truck come by your place, or you could have people rent out your room for a party, for a wedding reception, or a birthday party or something of that nature. That is perfectly fine. If they want to brandish their own alcohol, that's fine too. You as the association just cannot do that. Okay. So if you have association events, make it BYOB. Do not serve or do not manufacture or profit from that. Hired and non-owned auto, you will see some of this. We get this question quite a bit. This was more pertinent to associations a few years ago. I will tell you that it is not as pertinent now with all the electronic stuff that we have going on, that we don't have to go to the banks as often. We can do Zoom as more. What this really covers is if you are a board member or somebody working on behalf of the board, get into a car accident in your vehicle or even a rented vehicle like a U-Haul, and your primary personal lines coverage is not enough to pay for the damages, the association's coverage for hired and non-owned can kick in for that. A special events policy. This is something, if you're going to have people from outside your community come into it, this could be a farmer's market, swim meet, large garage sale, things of that nature, like super large garage sale. I'm not talking about one that's like 4 or 5 neighbors. I'm talking a huge. If you're going to have those things, then I would maybe get a special events policy. Really, it's because your general liability is based on the number of units in which you have. And so we need to make sure that if you're bringing in people from outside the community, you're increasing your liability. And we need to make sure that there's a policy to cover those outside guests. Individual board member can make a claim because anybody on the board acts as behalf of the board. Somebody asked the question if a single person can make the claim. Really what's going to happen, and this is kind of the way it's going to happen, is if you get into an accident, for example, the example on here is the treasurer's running to the bank, gets into an accident, and their primary insurance doesn't have enough coverage, it would step in. What would happen is the insurance companies would kind of go ahead and step in, or the authorities or attorneys would go say, hey, we need to go ahead and activate this policy. You guys should activate this. Really what it is an extra step of protection for the association if somebody's doing work for the association and gets into the accident, because you could see in a situation like this where the treasurer is trying to run to the bank, and he says, I got into this accident because I was rushing to do this HOA business. And an attorney hears this, and an attorney is going to say, well, the association could be another member at fault here, because if the association had taken care of business, then this treasurer wouldn't be running to the bank at this time. So a lot of times what's going to happen is you're going to have this be activated because an attorney is going to try to rope in the association as an additional faulty. Okay. Directors and officers. This is the most important thing for you guys. So please make sure you have the right coverage here. I will tell you, I try not to write anything but the best directors and officers coverage. You are volunteers. Please, please do not skimp on directors and officers, because if you have a claim and it is not covered, or is not covered correctly for you guys, it could then affect your personal life. Okay. So please, please, please make sure you have enough coverage here. Directors and officers is typically $1 million in value. Ours also includes unlimited defense costs, meaning your attorney fees are always paid for. It also includes things like full prior acts coverage, which means anybody who was a board member would be covered if the claim was unknown. So say you got off the board and in 2 years, somebody sued the board and tried to sue you because you were on the board at the time the event occurred. As long as that wasn't known by any attorney or no claim had been filed at that time, it would be picked up under our insurance. Okay. We also have cyber protection under ours. A lot of other D&O carriers don't have cyber protection, which is now becoming a big thing because people talk on Facebook and Nextdoor and Town Square and all of these different places that they could say a nasty thing and somebody sue the board because of it, whether it be discrimination, slander, libel, harassment, etc. Okay, so these are non-monetary claims typically, meaning that they are not for a value of money, that there's not a specific money value that has been an issue. These are more of your discrimination or breach of contract type claims. Okay. It is a claims made coverage form. Yes. So it's when the claim's made, not when the policy, not when the occurrence was of the, so somebody asks, is our D&O policy a claims made coverage form? And what that means is it's when the claim is made, not when the event actually occurred. And so if it was an occurrence policy, then it would have to occur within that policy year. So for example, if the claim happened in 2021 and the filed in 2023, it would go back to the 2021 policy on an occurrence policy. On a claims made policy, the current insurance would then take that form, take that claim. Okay. Again, defense cost, more and more carriers are starting to add this, but it's one of those things. Defense costs outside the limits just means none of that $1 million limit that you have is going towards attorney fees. It's being paid separately out of a different fund, so you don't have to pay for that. Okay. Crime fidelity. This is one where some people think that they don't need it. I will tell you, it is one that you probably should need. The name of the former, what was the name of the coverage for the former board members? That's full prior acts. What that means is that we go back to the inception of the board. Other community or other D&O coverages might be what they call a pigtail, or a backdating to a certain point. Sometimes it's 6 months, sometimes it's a year, sometimes it's 9 months. Ours goes back to the inception of the board, which is a great thing. All right, so crime fidelity. Crime fidelity is going to protect your bank accounts, okay? And I will tell you, it's one of those things that you may not think you need until you need it. Recently, we had a community that had a board president's email spoofed, and then that email was sending bogus invoices to the management company. That management company, thinking they were paying out on behalf of the board, paid out upwards of $80,000 of coverage. Okay. Now the management company is not at fault because they weren't thinking they were paying anything that wasn't on behalf of the board. So the associate, and because it's the association's money, not the management company's money, it's the association's responsibility to cover their money. Even though Goodwin manages your money and pays your bills, you are not a named insured under their crime fidelity policy. You are not guaranteed coverage from their crime fidelity policy if you have some sort of theft or issue with money. So you need to have a crime fidelity coverage. This is cheap. For $100,000 in crime fidelity coverage, it's $296 a year. So it is not expensive. One new thing that they're talking about is called social engineering. Social engineering is just a fancy term for cyber protection under crime. And what this does is it protects you against those incidents where an email may be spoofed, or phishing with emails that cause money to be taken out of bank accounts. Okay. It is not on everybody's crime fidelity. It is on ours. Ours is the most comprehensive. Again, it is through the same company as our D&O. They work tandemly when it comes to cyber issues. So it is one good thing to have those. Just make sure you talk to your agent about having crime fidelity on there. It is not an expensive policy. Now, one side note or special note, if you're a condominium, FHA loans may not be approved if you do not have a specific amount of coverage on your crime fidelity. And what that means is if you do not have your reserves plus 3 months of assessments, they may ask you to actually increase your crime fidelity coverage or obtain crime fidelity coverage in order to approve an FHA loan. Now, I have had people who say they do not want FHA loans in their community. Whatever, that's their choice as a board. But if they do have a crime fidelity and they want to get this loan approved, then they may need to increase their coverages. So what you need to look at, and this is a rule of thumb for all communities, is take 3 months worth of assessments plus what you have in your reserve accounts, and that's about the baseline of what you should have for your crime fidelity coverage. Okay, I will tell you most communities carry between $25,000 and $100,000 in crime fidelity. I've seen some upwards of $2 million in crime fidelity coverage. Umbrella. Umbrella used to be the easiest policy of all to write. It has now become a massive pain in my rear end. Okay. And the reason is the two main umbrella carriers last year, January 1st, 2022, started non-renewing every umbrella policy that they had. So for those of you who may have got a cancellation form for umbrella, this is why. The two main carriers were very cheap. They went over pretty much everybody, and they went over everybody's directors and officers. They decided that they just didn't want to do it at the same anymore. And so it threw this market for a twist. Umbrellas went from about $250 to $450 for $1 million coverage to now $1,000 for $1 million in coverage or more. Okay. So you may have seen, increases on umbrella policies. I will tell you, you should have an umbrella. Are you guys not seeing my slides?
I see them.
Okay. We'll send this out. I'll make this available for you guys so you guys can also keep this and have this and share it with the rest of your board members if you want to.
Okay.
And this will also be on Facebook. This whole presentation will also be on Facebook under the Goodwin Facebook page later on. Okay, probably in the next few days. Now, umbrellas, if you do not have a pond, a pool, or a playground, you probably do not need an umbrella coverage. Or if you're not a very large community, for example, if you are 10 units or 30 units or 100 units, and you know all of your neighbors and you're not going to sue each other very much, it's probably not need for it. The reason I say a pond, and a pool, and a playground is those are the most likely areas that you're going to have massive injuries, death, or dismemberment, which are going to lead to your larger claims. Okay. If you have good D&O coverage, good general liability coverage, very rarely are you going to hit that $1 million mark. An umbrella does not kick in until you use up all of the limits of your general liability or directors and officers. Most umbrellas today have trouble going over both GL and D&O because they are what we call follow policies, and they are specific on which policies they'll follow. So it may go over the general liability, but it may not go over the D&O. Okay. It is more important to have it over the general liability than it is over the directors and officers if you have good directors and officers coverage. Okay. Because you're going to have larger claims under the general liability than you will under the directors and officers. I have been in this industry for 6 years on this particular industry, and I've yet to see a D&O claim go over $1 million. I've seen many GL claims go over $1 million. Okay. Workers' comp. This is real quick. This is where you might see something of the name employee. We know that you do not have employees. Okay. I'll answer your question just in a second, Dean. Standard worker comp policies are $1 million. These are really cheap. These are what we call ghost policies. A ghost policy knows that you do not have employees or payroll or W-9 or W-2 employees or even 1099 employees. This is just to protect the association from vendors who come onto the association that may fib that they have workers' comp and they have a work-related incident and try to sue the association. This also carries on a volunteer policy that allows people empowered by the board to do volunteer work around the community. For example, I have one recently that actually has board members that have gotten together to go around and actually take chainsaws to help clean up their neighborhood. They got a workers' comp policy right before they approved this so that their volunteers were covered if they go out and had a work-related incident. Okay, so it is something that you should need. It again, it is $275. Does not cost a ton. It's very easy to add. Some workers' comp may be $330, but one we typically write is $275, and it provides ample coverage like a true workers' comp coverage. Okay, we just know you don't have any payroll employees. Now, if your community has a payroll employee, for example, a maintenance worker or an on-site concierge, that is a different type of workers' comp, and that is going to be based on the type of work in which that employee does. And we're going to have to look at the tax documents to determine which tax code to use under the workers' comp, but we can still write that workers' comp for you. 99% of the communities out there are going to have this ghost type policy, meaning that there are no employees and that it's just sitting behind in the background for any vendors that may come on. Again, I've seen time and time again, a person who hires Joe Schmo off the street, who's a one-man operation, who doesn't carry his own workers' comp, comes on to do some repair work or some handyman work, and he gets injured and tries to sue the association. And if they have workers' comp, it would fall under that policy. Okay. So Dean, when we say our policies are, your policy is unique in that our insurance claims that are no. Short answer is no. When I'm saying our policies, I am typically talking about the people that we typically place our communities with, because we find that they are the best coverage. We are still going to go based on the governing documents, the regulations in which you guys need to be covered, condo regulations throughout the state of Texas, federal regulations, etc. We are going to meet all of those guidelines. We do not have access to every carrier out there. We do have some that are specific to us. We do have some that we just work with more that we're preferred with. I will tell you, but when I say our policies, I'm just typically talking about the ones we typically use. Okay, there's nothing really specific about those. Yes, the Texas law being passed 2 years ago permitting volunteers. Yes, that's why there was a shift. So 3 years ago, when I wrote this workers' comp policy, we actually had to add it on as an additional insurability part of it. We do also have a volunteer policy that is a very specific one-time volunteer issue. So if you have like, hey, we're going to have a group gathering and go clean up the green belt, we do have a policy that is one for a one-time event. I will tell you, it's actually more expensive. It's $300 for 100 people. It's more expensive than getting a workers' comp policy that includes volunteers. Okay. That's the one I'm talking about here. That's separate. Volunteer policy, that's separate. Okay. Again, this will all be shared with you guys. So it's one of those things that if you don't get it all now, we do this quarterly. So we will also go through this again, and then we will also come back. Now, we'll also present this on Facebook, and this can also be shared with you. I will make sure that Goodwin has this actual presentation, and then you guys can share it amongst your boards. If you also would like, I am more than happy to get with your board and talk about your insurance. Even if I don't insure it, I will tell you part of the thing that we do with Goodwin is it's kind of a scratch your back, you scratch my back type situation. There is no kickbacks, so I don't get any money from Goodwin. They don't get any money from me. None of the communities get discounts. I get paid by the carriers. I don't get paid by Goodwin. But I am in-house. I am here to help them, because if I help with the questions that they have, they are more likely to help push people towards us and help me make money. So, I mean, again, it is a business world, but it's one of those things that, you know, we've had the question in the past that is there a relationship with us that is maybe fraudulent or an issue, and there is not. We are specifically created just to help Goodwin, but we are not, if you leave Goodwin, we can still write your insurance. It is not exclusive to Goodwin if you are with us in insurance. Okay. There are some property management companies such as Spectrum that have Blue Lime as their insurance agency. I know there's a program with VCM that they have their own program. I know that there's a program with First Service Residential that if you leave those community or those management companies, you actually have to drop their insurance because they discount it with a special program that they have. We don't do that. The reason is it's a bigger hassle for you to leave if you left a management company or came to a management company and had to worry about insurance on top of all the changes that you have at that time. So we didn't want to have that as an issue. Now on the screen here is the claims process. I will tell you it's pretty standard. First and foremost, please make sure everybody is safe, stop any further damage, and call the proper authorities as you need to. Then you need to contact your agent and also take pictures of damages that may have occurred. This will then help with the claims process later. Talking with your agent is going to help determine whether you should file a claim or not. Again, an agent cannot determine coverage, but they can assist you in determining whether or not it is a good idea to file a claim or it is possibly going to be covered. Okay. Or it may not even hit a deductible and they may say, hey, you're not going to hit a deductible. This may not be a good idea for you guys to take on. Okay. So this is our standards claims process. Again, this will be shared with you. I don't want to bore you with reading through everything here. And then a checklist, again, this will be shared with you. This is something you can use as just a quick reference guide for you guys later on. If you're really good with computers, you can take a snapshot right now. But again, will be shared with you. Again, it's just overall talking about the different lines of coverage, what limits you should be looking for, things that you should be looking for in the coverages that you get. Again, the standard coverages that most people will have are your property, general liability, directors and officers, crime, umbrella, and I will throw in workers' comp as well. Okay. So I'm going to stop sharing my screen here. Oops.